evening and welcome to The Big Question. I'm Sanjana. I have a question for you this evening. Do you think that the era of inexpensive instant groceries is slipping away faster than your 10-minute delivery timer? Let me give you some context. Just 2 years ago, India's quick commerce apps promised everything at your doorstep. Faster, fresher, and almost free. But 2025 has brought a reality check. Platforms like Blinkit, Zepto, and Instamart now tack on new fees for almost everything. Small orders, big baskets, bad weather, peak hours. Some consumers are seeing delivery costs swell by 1 to 3% over advertised prices. Why? Because behind the bright app icons and the promise of deals is a brutal math problem. Let me break it down. Blinkit alone posted an operational loss of 178 crore rupees in the last quarter. Delivery costs have spiked with inflation and rising fuel prices. And with 80% of the market controlled by 3 players, competition isn't driving prices down anymore. Meanwhile, India's consumers, you and me, and millions of whom embrace these apps for convenience are starting to ask, are these quick fixes still worth it? Or are we paying for a convenience that's becoming unaffordable for both households and the companies behind the scenes? To break this down, we have an expert panel as always who understands this market from every side. I have K. Ganesh, promoter of Big Basket, Bluestone, Homelane and Portier. He's invested in and built some of India's most prominent consumer internet businesses and knows what it takes to scale sustainably. I have Mandar Lande, co-founder of Vayu, an innovator in homegrown delivery platforms with fresh ideas on how to keep costs low and customers loyal. Amit Verma, former vice president at Zomato, he's seen the economics up and close and knows what it takes to make the numbers work. And Madhulika Tiwari, partner at the Knowledge Co, one of India's leading analysts on retail and consumer goods, with a sharp eye on how consumer expectations are shifting. So, is the era of affordable instant groceries over or just evolving into something less magical and more realistic? Let's find out. First is the promise and the pitfall, and let's get into why quick commerce grew so fast. And let's begin by understanding whether this was inevitable or was cheap quick commerce just a bubble waiting to be burst. So, K. Ganesh, I'm going to come to you first. You've backed and scaled multiple digital-first businesses. Was this a long overdue correction in unit economics, or have platforms misjudged the Indian consumer's price sensitivity?
No, so I think it's a very valid question. If you specifically talk about Q-commerce platform, or to some extent even the food delivery platform, the platforms had to change consumer behavior. Just 3 years back, nobody really thought we needed grocery in 10 minutes. Now, all of us want everything, including medicine, Apple, iPhone, Samsung phone in 10 minutes. Now, to change consumer behavior, you need to induce trial, make people addicted to it, taste the convenience, and become habituated. That needed discounts. Actually, this platform fee that's being introduced, various kinds of fees that's being introduced, is not really greed from the platform owners. It is the cost pressure. So now that inducements have been given, trial has happened, habit has got formed, people feel they value this particular convenience of 10-minute delivery, they will be willing to pay, is the question. Now, I'm not against that because it's needed for the platform, but what is really concerning is the way it has been introduced at the cost of upfront transparency. Somewhat people may call it as dark patterns, and government and the regulators are looking at dark patterns hidden somewhere under various heads. Those are concerning. Charge it upfront, charge it clean, charge it clear, saying that this is what it will cost you to be able to do that. And many of the apps, and I don't want to name them here, you have named some of them, they are using dark patterns to hide it, to misguide the consumer. That is a challenge. Now, some of them are leading towards IPO. Therefore, there is unit economics pressure. There is a pressure to ensure that they show profits at least at unit level. So this was inevitable. I don't think it's a bubble. I think consumers will still do it because, as you rightly mentioned, 3 of the players control 80% of the market and they can actually dictate the term. I remember 10 years back when we were doing Big Basket early days, not the Q-commerce Big Basket, but original.
Okay.
And the same applied for Flipkart also. whenever we put a delivery charge of 10 rupees, the conversions used to drop dramatically. That's no longer the case because the convenience people have used to so much that the numbers will show. But this is not new. 2023, Zomato, Swiggy introduced a fee and it did not hurt them in any way. So platform fee has been introduced earlier and we have seen it in food delivery, it being charged separately in addition to the to increase the take rate. So I guess I'm assuming the same thing will flow here. I don't think the numbers should go down in any way, but more transparent, clear fees would be good for the consumer.
Sure, sure. Okay, so a chicken and egg and demand and supply kind of statement is what you're saying, K. Ganesh. Madhulika, when you look at pricing psychology, especially in mass market India, how damaging is it when a consumer says, see, a 499 rupee cart suddenly become 599 after fees? Does this erode trust permanently?
See, again, as Ganesh mentioned, that, till now the category was not created. The players actually, were focusing on creating the category. There are costs involved. And today, profitability for any sustainable business is critical. And that's where charges are required. It's fine. What consumers are looking at, is that charge justifiable? Is there transparency in pricing? What I am paying for, am I getting it at the right time? Am I getting it in the right quality? Is my product not expired? These are some of the things which needs to be taken care of. And as long as that is taken care of, I think consumers will be fine. So at this point, yes, it is a shock for the consumers because they were not used to paying this. But over time, as long as the players are able to justify and give a more transparent communication and visibility on why they are charging and how much they are charging, I think in the long run, this is the way forward. We see it happening this way.
So consumer forums have seen a 35% rise in complaints, having said what you are saying, Madhulika, in about hidden charges since January. Revised policies are expected to improve take rate. So a take rate, viewer, is essentially the platform share of the gross order value from 10 to 12% to about 15%. Amit, having led growth at Zomato, you've seen how customer expectations can swing. Do you think consumers will accept these new costs as the new normal, or is there a risk of a mass pullback?
See, at the end of the day, the consumers have to pay for what they're getting. So they are getting delivery in 10 minutes or under 10 minutes. So at the end of the day, the consumer will have to learn to pay for the services that they are taking. And, in the earlier days, companies were vying for market share. And they were giving aggressive offers and discounts and coupons to get the market share. But this cannot continue in the long run. As one of your panelists earlier said, that the profit pressures are coming on the companies. So eventually it will come down to the customers. So eventually, in long run, customer will have to get used to paying the delivery charges and the excess charges that are being levied. So this is there for the long run, and it is going to continue, and the customers eventually will have to get used to it.
Would you have any data points on whether basket sizes are shrinking already in response to fee creep?
See, I don't have current data with me, but as per my understanding, the average order value is increasing, and that is particularly because of the fact that high-priced SKUs are being introduced, like mobile phones, coffee machines. You have different categories being introduced, which have high product value. So as we go forward, more and more SKUs will be introduced, and you will see a higher average order value going forward.
Okay, so let's ask if there's an alternative, something that's slower, cheaper, and local, Vayu Mandar's platform has been quietly scaling by betting on a different model, partnering directly with local merchants, keeping fees low, and prioritizing profitability over speed. Mandar, you've built a model that is in many ways the antithesis of quick commerce, right? So with
Yes.
Blinkit and Zepto rolling out these surcharges, do you see an opportunity to pull price-conscious consumers back to slower, fairer delivery?
Yes, absolutely. I mean, while we respect the scale that these big three have achieved in the e-commerce segment and the way they have solved the problem, but at the same time, there has been some kind of pressure that has been mounting on the merchant side of it. Probably they have not been so vocal so far, but at least in food delivery segment, like we have got this chance, to communicate with restaurant owners. So they are all feeling the heat of, this the increasing prices, the increasing charges, more than like 25%, 30% commissions on every order, and eventually it is getting down to the consumers as well. So as Vayu, like we being a completely zero commission model, we have found a way of scaling up even without charging this. So in fact, on our platform, we don't have any kinds of these kinds of charges. Which we think this is detrimental to the merchants. The Because it is their business, they have to drive the profitability. So with zero commissions, we are able to achieve like we are not even having surcharges, we are not having platform fees. At the same point, we are able to deliver the same quality food in the same time, right? So we think that with these platforms scaling up, they are like new kinds of problems that are erupting. Probably platforms like Vayu will come and try to solve this. Then we'll be able to create a sustainable environment both for merchants and consumers.
Okay, but would you say you can match the variety and I dare say the instant gratification that keeps consumers hooked to the 10-minute apps?
Probably will take some time
Okay.
because now we've since we have to create awareness. But I think zero commission, this model itself has the power of that making this entire ecosystem self-sustainable, wherein we'll be able to run for a longer period of time. What we think at this point is probably this is a bubble which will probably burst in like 3 to 5 years from now. But having said that, yes, I mean it is difficult to implement it to that scale. But we are able to do it to a certain extent, and we are confident that we'll be able to create the alternative.
All right. So as the economics get real, we're all saying that platforms obviously face a little bit of a hard choice: consolidate, diversify, or raise prices further. Ganesh, is consolidation inevitable now? Will we see smaller players exit as costs mount, or can new models emerge?
I think, like the Vayu was mentioned, new models are emerging. If you look at it, vis-a-vis Uber and Ola, Namayatri has done exceedingly well. And Namayatri, to some extent, has forced the traditional ride operators to reduce their 25% or so commission to either a subscription level. Ola has changed their way they are charging on the platform. They are charging drivers to a subscription model. So therefore, it is always good to have new models coming in, challenge the monopoly, duopoly, or limited number of players on the platform. So I wish organizations like Vayu a lot of success, because that will put pressure. Otherwise, you have only 3 players or 2 players holding it. Just like in ride hailing now, Rapido is giving a very good run. So you will see new models emerge definitely to be able to do that. Not because they are charging this platform fee, but it is very much needed. Otherwise, the consumer will be at a disadvantage. Namayatri, Rapido help level the playing field for the consumer. On to your earlier question, is the order values increasing? Yes, that is a standard nudge economics that platforms are driving. By charging more for lower value orders, they want the people to order larger. Because if you order a 20 rupee item, the delivery charge is 60 rupees, there is no way platform will make money. So that is again par for the course. That they are trying to nudge you to order higher. Also, on the same point, if you see, the SKUs that they stock are larger pack SKUs. For example, the 5 rupee biscuit packet, which is the world's largest selling biscuit from one of the top brands, you will not find in quick commerce. You will find the brand, but the minimum size will not be one packet of 5 rupees, but a 25 rupee bulk pack. Those are all par for the course. What I really wish is that these fees are transparently upfront stated, not left to consumer awareness. And these dark patterns should be avoided to build trust, and the regulator need to do something about these dark patterns. Otherwise, today it's a mayhem. The number of fees, like you rightly mentioned at the beginning of the program, rain fee, delay fee, traffic fee, jam fee, this fee, that fee. I mean, those are all confusing, and most of the consumers in a hurry will not be able to see it. So be transparent, be upfront, charge the fee, and let the market determine the best players to win. I'm sure new models will emerge.
Okay, so totally hear you on that, and I think dark patterns is definitely a conversation to be had, something that we've also been covering very closely on NDTV Profit. But for years, this 10-minute delivery was sold as progress, right? But when every drizzle or rush hour becomes a new surcharge, is this a fair ask or just an unsustainable addiction to speed? Madhulika, is there a threshold where Indian consumers simply walk away? What does your data show about the tolerance limit for add-on fees?
So again, as I mentioned earlier also, today, quick commerce is a sizable segment. It's about a $6-7 USD billion. And customers today are ready to pay, but what are we paying for? Are we paying for rain charge, or are we paying for any type of surcharge, and on a daily basis that changes? Are we looking at that, or are we looking at some 2-3 charges, fees that we are comfortable about, and we say that yes, this is a cost which is required, a platform handling fee, or sometimes surcharge which is there because of high demand, but again, to what extent? So consumers have to be left with that alternative, and they are exercising that today, whether they want to pay that fees and want the products in 10 minutes, or whether do they want to wait and say that, listen, I will take it maybe a few hours later or the next day. So I think that is evolving. We will also see that in the coming times. So that's how we see it. So it's going to even the players are experimenting today. So we can't say that we've reached a stable state and this is going to happen continuously in the future. So even players are experimenting. Customers are also trying out different platforms. Today, should I go to X or tomorrow to Y, and see which one is better? So yeah, it will take some time. It will take some time for all of them, for this whole segment to evolve.
Absolutely.
And reach a stable state.
And I think it's fair to say that all of us, right, whether it's on the consumer side or the business side, everybody is in a 24/7 pilot mode when it comes to quick commerce, right, as more players kind of increase. Amit, just let's shift focus now, because one reason for these charges is the gig workforce that costs and delivers guarantees, right, under 10 to 15 minutes. That's something that I think has been established, and that's common across platforms. In your experience, what operational lever would you say actually moves the needle? Would you say it's a dark store automation? Would you say it's reducing a delivery radius, or just simply slowing on delivery promises?
So since I was part of it, which is a division of Zomato, I wouldn't get into the too many operational details, but I can tell you for sure one thing, that at the end of the day, gig workers are the people who we see at the last mile, and they're the people who are actually delivering the service to the final consumer. So we see their cost as the main cost, but actually that is not true. Yes, that is one part and parcel of the component of cost that is involved, but there are multiple costs involved. You have complete tech that is supporting this infrastructure. You have dark stores that are supporting this infrastructure. You have shrinkage, pilferage, then you have manpower cost, you have housekeeping, pantry services cost, rental cost. So all these costs, when they are put together, then they become a substantial amount which the company needs to recover from the final consumer, and that is where the pressure is coming from. And if you see either Swiggy or you see Zomato, both of these companies are public companies, and they need to show profits somewhere down the line. Maybe not today because they're expanding, but at the end of the day, going forward, they will have to show profit to the investors and to their all the stakeholders. So that is where the actual pressure comes in for charging the consumers one or the other charges, because every small drop fills the bucket, and the small charges, that is in terms of rain charge, surcharge, or any other charge that you can think of, it is because of that pressure that is building up on the companies.
Absolutely. Mandar, would Vayu ever consider pivoting into groceries or essentials delivery, or is that fundamentally incompatible with your model?
No, definitely. So just to tell you, before we came up with Vayu, we have onboarded like 10,000 plus retail stores,
Okay.
all 80% of them being groceries on a platform called Meri Dukan.
Okay.
So we tested huge success with our zero commission model. So we are able to create that sustainable thing, out of the zero commission. So definitely, like immediately after Vayu, like we reach at a certain stage wherein we have a good market share. We're definitely considering venturing into groceries as well, because we think we can solve this problem to a certain extent.
Okay. So then let me ask you, what innovation could realistically bring costs down again? Would it be automation? Would it be micro-fulfillment or something else?
I think it has to be like, all bits and pieces have to be put together. So wherever you see the downfalls, you'll have to work upon improve the unit economics there. It's like you'll have to go to the minorist level. Just Amit has rightly pointed, there are lots of factors that affect the cost. So you'll have to work on everything to manage this. So that's where, like, see, we being a tech company, we don't want to get into the specifics of delivery, or probably not the specifics of creating food, or even for that matter for grocery. But we know how to put all these things together and pull the cost down. We are not charging commissions, and that's where we are not getting that pressure of charging higher and higher every day. What we are charging is monthly subscriptions, and for us it's a game of scale. So the more number of restaurants or the more number of groceries stores they are onboarded, more will be able to create a sustainable model. For us, we need to solve the problem first, and probably then will be the right time to scale on top of that.
Yeah, I think over digital first, yours is a more consumers first model, right?
Yes.
Okay, Ganesh, then in your view, have platforms potentially underestimated how quickly Indian households can adjust their habits back to offline or planned purchasing? Easier to run down to the Kirana store then?
No, I think that ship clearly has sailed.
Okay.
It has stunned everybody, including people like me who knew e-commerce and e-grocery, on the consumer adoption of quick commerce. 5 years back, if you'd asked me, I never would have thought people would want things within 10 minutes. I live in Bangalore, where to travel 1 kilometer take 20 minutes. I mean, why would you need anything in 10 minutes? Okay, right? But that question has been asked and answered. People want everything in the quick commerce style. You have today fashion, you have food, you have phones, and you have electronics, all of that stuff. I think that question has been answered. So I don't think people are going to go back. Now, what platforms are doing is very similar analogy. You must have heard the story of how do you boil a frog without frog jumping out. You keep on slowly increasing the temperature of the water, so that the frog at any point of time feels comfortable that the next increase is only a marginal increase. That is what platforms are doing to Indian consumer. Slowly adding on one fee, second fee, third fee, fourth fee. So at every point of time, you're thinking, oh, it's just 5 rupees more. Am I going to revert back to my original, run to the Kirana store at 5 rupees more? What's 5 rupees? Let me pay the platform fee and get soon with it. Similarly, 10 rupees surcharge. So boiling the frog is what is happening, and platforms are smartly doing it so that it's not a sudden increase in temperature. If you take a frog and put it in boiling water, it will jump out, but slowly increase, it won't. So that is what is happening. Now, question is, uh, will it ever come to a situation where the frog realizes, now I'm boiling, I'm going to jump? I personally don't think so. 5 rupees is small for a consumer to be able to avoid the convenience of going to Kirana store. But for the platform, suppose it does 40 lakh deliveries a day. That's straight away 2 crores to the bottom line.
Absolutely.
2 crores of extra money. Okay, right? per day. Okay, full profit. That can change the whole game for listed players. I think that's what is happening. But honestly speaking, do it transparently. It is fair enough. They are running a business. We have Indian consumer has long got the benefit of foreign funded, venture capital funded discounts and promotions, and we enjoyed the convenience. Sometimes there is no free lunch, and sometimes you have to wake up and say, yes, this convenience is going to cost me that money. Otherwise, I will have to go and get that goods and come back. I think it's par for the course. So I'm against the way they have implemented it, but I think that's a reality. How long will a foreign institutional investor keep subsidizing my convenience, my reluctance to go to the Kirana store and buy?
But I think having said that, Madhulika, please correct me if I'm wrong here. Quick commerce penetration is still largely urban. So could these new charges effectively kill quick commerce ambitions in say, tier 2 or tier 3 cities where the spending power is lower, would you say?
So in my opinion, at this point of time, yes, quick commerce is, restricted to the, 20 top cities. But the way things are going, we could see some, penetration even in the tier 2 cities. But again, that's going to take some time. We understand even the players are saturating the bigger markets first, and then they are looking at the smaller markets. It will take some time, and even the players will evolve over time and bring out, concepts for the smaller markets. So yes, we'll have to wait and watch.
Okay, so looking forward, whether this is the end of quote-unquote cheap delivery or the start of a more rational market, Amit Verma, as platforms move towards IPOs, will investors accept slower growth but better unit economics? What would you say?
So coming to your earlier question regarding the prices, will they come down? My take on that is that, the days are gone. Earlier, the companies were, trying the customers. They were asking them to use these platforms because nobody had thought about these ideas in terms of getting delivery done in 10 minutes. So there were heavy discounts, heavy offers. The consumers were getting very sweet deals. But I think it is time for the consumers to also smell the coffee beans. And now, going forward, I think the prices are going to increase here. From here on, you will have an increase in prices only. More charges would be placed in. But the good part is that as the average order value of the products increase, the percentage of delivery cost and all these associated costs gets lower and lower. Because let us say if you are having an average order value of 1,000 rupees and just take a notional charge of 100 rupees of delivery, that's 10%. But if your average order value increases to 10,000 rupees, then even if your delivery charges and sundry charges increase to 200 rupees, they only become 2%. So going forward, the average order value, increasing of average order value through increased number of SKUs and increased number of product through offering higher products or at higher prices would be the key to success in the market.
All right, Amit, Ganesh, Mandar and Madhulika, thank you so much for a riveting and very, very exciting discussion. This evening's debate has made one thing clear. India's quick commerce revolution is at a turning point. For all of us as consumers, you and me, this means weighing our love of instant gratification against the reality that convenience isn't always cheap. Quick commerce sold us the promise of instant, effortless convenience, but as the hidden costs surface, the consumer must ask, is it worth paying ever-rising premiums for speed, or is this the moment India resets its relationship with instant everything? That's the big question, and as always, you'll hear the answers here first. Thanks for watching.